You run a limited company. You're likely overpaying £3,000 to £5,000 in tax every single year. I'm Mustafa, I'm an accountant, and here are 7 ways to legally fix this. Let's go. I see limited company owners constantly overpaying tax, not because they want to, and not because they're necessarily doing anything wrong, it's because they don't know what they're entitled to. These 7 strategies that I'm about to mention are completely legal, they're completely ethical, and you could say HMRC approved. And they're going to save you thousands. So let me show you. Now, number 1, you need to have the optimal salary and dividend split. So firstly, you need to get this right. And most people, they get it wrong. Now, the optimal strategy, as everyone seems to throw about, is take £12,570 as a salary and then take the rest as dividends, because it's generally the most efficient route. Now, there's a couple of reasons behind this. Now, firstly, that £12,570 is completely tax-free. There's no employee NI, and it also helps you build national insurance credits. So this helps with state pensions going on into later years of your life. And it costs very minimal in employers NI. If you do pay employers NI, you're paying around about £1,135. Now the remainder of that bit, that can be taken as dividends, and dividends aren't subject to NI. And they generally have lower tax rates. So you're either paying 8.75% or 33.75% if you're up to the higher rate. Now let me show you why this strategy might be wrong for you if you want to take out £60,000 from your business. Now option 1, if you took it all out as salary, you'd be paying income tax of £11,428. You'll be paying employee NI of £3,210 and employer NI the company will pay of £8,250. So the total tax and NI personally that you're going to be hit with is £14,638, and the total extra cost to the company to give you that salary is going to be £8,250. So overall personally, you're going to be keeping around about £45,362. Now let's compare that if you split it between salary and dividends instead. So if you took a salary of £12,570, it's going to attract some employer NI of £1,135.50. Now, you'd pay corporation tax on whatever's left. So taking account of the £60,000 payment, if you've paid yourself a salary now and paid the employer's NI, you're left with about £46,295, on which you'll be paying up to 25% corporation tax. Now, let's say you did pay 25%, you'd be having a corporation tax bill of £11,575. Now, the available dividends after that are £34,721. Now, the tax on dividends personally, which will be £2,994. So at the moment, the overall tax to you personally is just going to be on the dividend side, which is £2,994. However, the total cost to the company is going to be £12,710. And overall, personally, you keep £44,297. So in this specific situation, if you were to follow the guidance of everyone and take the salary and dividend split, you'd generally be paying and taking home a little bit less. Now these figures of course will vary dependent on the corporation tax figure, but you see my point here. Just because something works for someone else doesn't necessarily mean it'll always work for you too. Now number 2 is where you use employer pension contributions. So you can use employer pension contributions instead of just taking dividends each year. And this is a huge thing for higher tax rate payers. Now the strategy behind all this. So your company will pay into your pension. It pays it directly via an employer contribution. Now the benefits behind this is that it literally saves corporation tax, anywhere up to 25%. So you pay no dividend tax on that money and it goes straight into your pension tax-free, and it also grows tax-free over the years. Now if you were to take a 10k dividend, instead of putting it into your pension, let me show you the math. So you'd be paying corporation tax on that 10 grand of £2,500. Now the net available there for dividend will be £7,500. Again, if you pay dividend tax at 33.75 in the high rate, you'll be looking at about £2,363 in dividend tax. So in your pocket, you get £5,137. Now if instead that whole 10k was shifted into your pension, you save that £2,500 corporation tax you would have potentially paid. There's no dividend tax, and that £10,000 goes straight into your pension. Now this helps the people who don't need all the cash right now and are considering building longer term wealth. Now number 3 is to claim all business expenses. You need to claim every single legitimate business expense you can. Most people, they underclaim because they're scared or they're simply unsure what to claim. Now these are some commonly missed expenses. Let's talk about the use of home. Now HMRC allow a flat rate expense of £6 per week, which works out to about £312 in the year. Whereas if you used optimal calculations, rather than just using the flat rate, here's what you could potentially benefit from. Now let's say your business used 20% of your home. So now all these expenses can be apportioned and 20% can be claimed within the business. So let's say your rent and mortgage, the 20% use of home is £80 a month. Council tax is £40 a month. Utilities are £30 a month. Internet, £40 a month. Now the total cost here is almost £200 a month. That's £2,400 every year in taxable relief. Now next up is business mileage. So for the first 10,000 miles you do for the business, you can claim up to 45p. Anything above that, you get 25p. Now if you drive 5,000 business miles in the year, that's £2,250 business deduction that you've left on the table. Now other commonly missed deductions are things like professional subscriptions, training courses and books, any business insurance, marketing and advertising, softwares and tools like your accounting suite, any accountancy fees you incur, bank charges, and even your mobile phone contract, as long as it's the business portion. Now let's say you're missing £3,000 worth of expenses. That's up to 25% corporation tax you're going to be paying. That's £750 every single year. Now number 4 is to use capital allowances properly. You need to claim any capital allowances that you can on equipment. The AIA allowance at the moment is £1 million and you can claim 100% of that in year 1. Now let's say you buy £5,000 worth of equipment, a laptop, a camera, a desk. If you use capital allowances, that full £5,000 can be claimed in year 1, giving you 100% relief. So you'd save about £1,250 in corporation tax. Now the things that can potentially qualify are things like computers and laptops, office furniture, equipment and machinery, certain vehicles, but there's a lot of restrictions behind that, and software. Now it's a really common mistake completely not claiming capital allowances because you're unsure if something qualifies. Now number 5 is to involve spouse or even family members. If your spouse earns less than you should involve them in the business if you can. Now you can make your spouse a shareholder in the business and you could also pay them a salary too. You can split dividends between two of you, and you can make sure you're using their personal allowance and their basic rate band fully. Now let's say you took 60k as dividends all personally, just you. You'd be paying anywhere up to £6,539 in just dividend tax. So on the other hand, if you took 30k personally and then you gave 30k to your spouse, your family member, whoever, your personal tax bill on those dividends is only going to be around £1,481. Now your spouse or whoever else will also pay that too, so double that up. You're now at personally being taxed £2,963. Now if you compare that back to taking all the dividends yourself, you're saving almost £3,400 every year. Now at higher profit levels, say you're breaking the 100k barrier, this saving could be massive. Now there are some critical requirements behind this. So you do want to make sure that your spouse is a genuine shareholder. Make sure you properly issue any shares. Make sure they're documented at company's house and that they're actually entitled to dividends. You can't just give them money, and it must be a proper dividend payment. Now number 6, don't extract all the profit. Leave some money in the company. Only really take what you need to actually live off. Anything else, try and hold that in the company. The reason behind this is you could potentially extract that money later when you're in, say, retirement, when you've taken a career break or any other reasons. Now this can help people who are building their wealth for retirement, business owners who don't really need all the cash flow right now, and as I said, anyone planning a career break or sabbatical, so they can extract the income when income drops. The common mistake is that people see the money in the bank, they see the cash there and they think, let me just take it. Now here's a bonus tip. You want to review your numbers every single quarter. Don't wait until the year end when everything's done and dusted. So this is what you need to review every quarter. Number 1, are you on track for your profit target? 2, should you adjust dividend payments? Number 3, can you make any potential pension contributions? Number 4, have you claimed all expenses this quarter? And number 5, is there any equipment that you can buy before year end? Now you might be wondering why quarterly. Now quarterly does matter. If you tax plan in December and your year end was back in April, you're too late. Most optimizations need to happen during the year rather than after. Now here's a quick note on the changes in April 2026. The dividend tax is going up by 2%. So the basic rate and the higher rate are affected. Now basic rate is going up from 8.75 to 10.75 and the higher rate is going from 33.75% to 35.75%. Now this makes these strategies that I've just talked about even more important, especially if you're considering employer pension contributions, considering involving spouse to split dividends and not extracting all profit. The changes do make dividends slightly less attractive, so make sure that you do optimize every other thing that you can. Now these 7 strategies are not complicated, they're not risky, and they're completely legal to do. But most people don't do them because they're unsure. Now if you're doing at least 5 of these 7 things, you're paying more tax than you need to. And that's money that you could be reinvesting in the business, saving for retirement, and actually just keeping yourself instead of just giving it to HMRC unnecessarily. So if you're watching this and want help implementing any of these steps, you now have two options. Option one, you carry on doing it yourself. You hope you get right and hope you don't make any potential expensive mistakes. Option two, you get someone who does this every single day. You can book in a free discovery call with us. The link is in the description. Just fill out the form. We'll review your whole limited company structure at the moment. We'll see which strategies you're potentially missing and calculate your potential savings. So click the link below and let's see exactly how much you're leaving on the table.